So that extended the fake bond rally for decades beyond its natural business cycle. But now it's at the end. So now all the central banks will collapse simultaneously, which is, we've never ever seen anything as globally catastrophic.
Hello and welcome to Wealthy Value. In today's video, Max Keiser and Stacy Herbert highlight the key factors that can contribute to the collapse of global economy, increase in money printing, and the black hole of debt looming over America. Make sure to stay until the end for an amazing pre-sale opportunity in Futurent, an NFT platform that enables fractional ownership of real-world assets such as real estate and luxury cars. If you're interested in getting into this project early, stick around until the end of the video.
Basically, that says the Fed has failed. Right? So now for year after year, for the last 20 years, 25 years, through Greenspan, Bernanke, Janet Yellen, Jay Powell, there's been this huge global coordinated talking point agenda that central banks are infallible. We've had some famous magazine covers before. After the 2008 crisis, we had the Committee to Save the World, which was Greenspan, Larry Summers, and Bob Rubin. We have this constant lionization of central bankers as heroes, that money printing and keeping rates artificially low is heroic behavior by the Mandarin kings that run the central bank. And now finally the Economist has admitted that it was a huge canard. It was a failure. It's a gigantic failure, as we've been saying now for almost 20 years, that you cannot print your way to prosperity. The fiat money decades only worked if you could, the principal way the fiat money fraud worked was to hide true price discovery in the commodity sector. So energy and agriculture and metals, price discovery was kept artificially low through money printing. And just a couple of months ago, we have a big commodity producer out there in Eurasia that said, you know what? I think we're going to call time on this. Now we're entering a period of commodity price discovery where commodities are going to go up, 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 and everybody tied to the paper money world will become increasingly more impoverished. You had commodities were big in the 1970s, then starting with Reagan and Thatcher, you had paper money took the place of commodities from the early 1980s up until 2022. So that's a 42-year period when paper ruled over commodities. And in 2022, now we're back to commodities ruling the global economy. And the ultimate commodity is Bitcoin. It's the fastest horse in the race, as Paul Tudor Jones has called it. That's still true today as it was 3 or 4 years ago. So if you love commodities, you are going to be ecstatic about Bitcoin because it's the ultimate synthetic digital commodity. Up until a few months ago, then time has been called on the imaginary fake paper money printing world, and now reality is asserting itself in a big way. So the bond market dropped so far. It's about $8 trillion worth of value has been evaporated in this bond market sell-off. And you've got, if you look at previous bond sell-offs, going back to a big one back in 1993 when the bond markets were down 3.5% or so, that was considered a very big wipeout in the bond market. This is more than double on a percent basis. It looks like there's room to go on the downside. The 10-year treasuries at just under 3%. That's up from 0.6% just a few months ago. The 30-year is also inching up. Mortgage rates are in the 5.5 to 6 range. That's up from under 3. So rates are telegraphing that the bond market, which is one of these Ponzi schemes that's been puffed up for decades, is starting to fall apart. And of course, the central bank is saying, we're going to raise rates. You can't taper a Ponzi scheme. And the game is that they hope that markets will come down to a point where there's panic and then they can launch QE5 and bail everybody out. Last time we visited this, the idea was that all the bad debts on the central banks, and the way they got that bad debt was bailing out Wall Street in 2008. You have $10,000, we're going to give you $100,000 of CBDC, but what they're not telling you is that within 6 to 9 months, you'll have zero.
Yeah.
The purchasing power will be zero. It'll be effectively zero. So it's not a bailout. It's not a bail-in. CBDC is just an outright confiscation, just wholesale confiscation, and that's the end game. So that's what they're teeing up right now. Well, the difference is in the old days under mercantilism, countries were competing with each other, and but the new phenomenon really starting with the 80s was the coordination of the fraud on a global basis.
True.
And so that extended the fake bond rally for decades beyond its natural business cycle. But now it's at the end. So now all the central banks will collapse simultaneously, which is we've never, ever seen anything as globally catastrophic. Because of quantitative easing, which was invented in Japan, Japan has always been what's called a funding currency. It's where every single country and every single hedge fund goes to borrow money at virtually 0%, and then invest it immediately into a higher yielding currency like a euro or a dollar, and you capture what's called the carry trade. You could get 2 or 3%, which doesn't sound like a lot, but when you're borrowing it close to zero or at effectively zero, and you can borrow infinitely, then you can turn that 3% into an annualized rates of return or 50 or 60%. Now you're doubling your money every 2 years. Okay, so that's Japan's role, has always been the go-to place to borrow money. And right now, the yen is seemingly out of control on the downside, which means that the ability to maintain that global open spigot of free money to fund this global Ponzi scheme, at the moment, it appears under extreme stress. If that cracks, I'm saying if that cracks, if the yen suddenly on Monday morning, you read the paper and like the yen has cracked badly and it's just absolutely falling apart, then that would be like a Krakatoa.
The fact that the yen is falling off a cliff against especially the dollar means they need more and more yen to buy those treasuries to keep the whole, entire Ponzi scheme. And the US dollar, the petrodollar, so dollar, oil, yen, like that's the backbone, and the euro dollar.
Before we go, we'd like to introduce you to the exclusive for sale of Futurent, an NFT real estate platform. Futurent is a blockchain-based rental and trading platform for fractionalized NFT real estate and luxury cars, heading into the metaverse sector as one of the pioneers in the field. To put it simply, Futurent is where DeFi meets real-world assets. Tokenization of real estate is the latest hot topic and an obvious next step toward traditional market adoption. Fractional investing makes real estate suitable for any budget, and Futurent allows you to invest in real estate and other assets with a few clicks in the comfort of your own home. Futurent is offering the strategic sale round $0.024, which allows investors to buy at a much lower price than the public round $0.030. For the strategic round, 10% of tokens are released at TGE token generation event. There is then a 2-month cliff, which means no further tokens are distributed for 2 months. Thereafter, the remaining tokens will be distributed monthly 25% per month over 8 months. 11.25% per month over 8 months. The vesting period means you won't receive all of their tokens immediately. This is designed to protect investors and the project for the long term. If all tokens were distributed at launch, there would be a massive pump and dump, and that would be the end of the project. By having vesting, it allows buy, sell pressure to be more balanced and give the project the opportunity to work through their roadmap and gain further momentum and investment. To become an early investor in Futurent, click the link in the description and connect your MetaMask wallet. We recommend doing this from desktop for a smoother experience. Choose your contribution amount and click Contribute. This is an opportunity to buy into the project early at a low price with an aim to make a really strong return over the next 12 months. This is not financial advice. Please do your own research. See you in the next video.